This is the Retirement Lifestyle Advocates radio program. I am your host, Dennis Tubbergen. Glad you decided to listen in today. Hey, I've got a terrific special guest coming up in segments 2 and 3 today. I'll be chatting with economist John Williams. Many of you who've been longtime listeners of the program will recognize John as a returning guest. John actually has the website Shadow Stats. Shadowstats.com is the web address. John actually tracks economic data like the unemployment rate, like gross domestic product, like the inflation rate, using the old methodologies. It probably surprises none of my listeners that as time has passed, changes have been made to these calculation methodologies to make the reported data appear more favorable. Well, I'm going to be chatting with John about the real inflation rate in segments 2 and 3 and what he forecasts moving ahead. I should point out that as I am recording the program this week, the Fed is meeting, and we have not yet seen what results the Fed may put forth. But my guess is, given what's going on in the stock market, that we see them soften their approach on this hawkish monetary policy that they were talking about pursuing. Today is the last day for you to get the January special report. The January special report is titled The Changing Face of Long-Term Medical Care. When you order the report by visiting the website requestyourreport.com, I'll send you the report. I'll also send you a copy of my best-selling revenue sourcing book, which contains a retirement planning strategy for the post-pandemic economy. There's also a lot of bonus information that you'll get as well. So again, to get all these free resources, all you need to do is visit the website requestyourreport.com. Well, certainly anyone who is invested in stocks or a derivative of stocks, maybe stock funds in your 401k or IRA, is certainly aware that we've had a very, very rocky start, and that may be the understatement of the year in stocks. Now, there is a technically significant indicator called a 200-day moving average. Now, I want to talk to you here just for a minute about the NASDAQ market. The NASDAQ market is tech-heavy. And the current price of the NASDAQ has fallen below its 200-day moving average of price. Now, this is, as I said, technically significant because often institutional investors will determine how much of their portfolio they want to allocate to stocks based on where this moving average is relative to current price. So what is a 200-day moving average of price? Well, if you're not at all familiar with it, it's very simple to calculate. As it relates to the NASDAQ market, you would simply add the closing values of the NASDAQ for the last 200 days and then divide that total by 200 to get an average. Averages are simply adding together numbers and dividing by the number of numbers that you added together to get the average. So the 200-day moving average of price, if you think about it this way, it's the market's consensus of value over the last 200 days. Over the last 200 days, this is what market participants think these stocks are worth. So when you have a current price that's higher than the 200-day average price, you have an average consensus of value in stocks where market participants are saying, hey, stocks are worth more now than they were on average over the past 200 days. And conversely, if current price falls below the 200-day average price, then current consensus of value is that stocks aren't worth as much as they were on average over the past 200 days. Now, what we're seeing in the NASDAQ market, as well as a couple other markets that I'll talk about here momentarily, is that last week, prices dropped below the 200-day average of price. Now, that's not all I want to point out as far as the NASDAQ market is concerned, because when you look at the NASDAQ market in detail, 40% of the NASDAQ listed stocks are already down 50% from their 52-week high. Think about that for a minute. 40% of NASDAQ listed stocks are down 50% at a minimum from their 52-week high. So the only reason the NASDAQ has continued to post higher numbers is because of a few stocks. The leadership is not there. There's just a few stocks leading the way, and they're the large technology stocks. Now, if you look at the S&P 500, you see now, just a few days after the NASDAQ, the S&P 500 has now fallen below its 200-day moving average of price, and the same thing is true of the Dow Jones Industrial Average. Now, I've been stating for a very long time that stocks are overvalued and could correct at any time. Now, there are many analysts that have been saying the same thing. Jeremy Grantham, who is an investing legend, there's no other way to put it, in June of 2020 said, we're in a bubble. In January of 2021, he wrote that there's going to be a spectacular crash in the next few months. Of course, that spectacular crash never occurred, largely because the Federal Reserve and all other central banks went all in on stabilizing the market. And 2021 saw markets close at or near all-time highs. But now it seems that the tide may be turning. In fact, if you look at charts of market tops in 1929, of the NASDAQ market in 2000, which is when the NASDAQ market corrected, the tech stock bubble blew up, when the Nikkei 225 blew up in 1989, and look at the chart today, you're seeing a blow-off top. A blow-off top defined as a steep rise in price followed by a steep decline in price. And as I said, all this taper talk by the Fed, all this talk of slowing the rate of currency creation or stopping currency creation altogether, stopping quantitative easing altogether, and raising interest rates has spooked the markets. And arguably, we are now on all indices, as I record this week's program, in bear market territory. Now, the Fed is in a difficult position here. I would say maybe even an impossible position. Now, why do I say that? Well, if they stop quantitative easing, if they slow quantitative easing, if they slow the rate of currency creation, which is all that means, we are going to see asset prices reset, in my opinion. You're going to see stocks crash. You're going to see real estate crash. The real estate market is already slowing because of higher interest rates. If you take a look at what's happened here in 2022 during the first month, you see that just talking about slowing the rate of currency creation has actually spooked markets significantly. Now, the other thing the Fed can do is continue currency creation. Now, we already have inflation at the highest levels we've seen in 40 years, and it's accelerating. So if the Fed continues currency creation to help the markets out, they risk inflation or perhaps even hyperinflation. So the Fed has two choices, and both choices lead to very bad outcomes. And that's why I'm offering, along with the free report this month, which is available by going to requestyourreport.com, a lot of bonus information, including the best-selling revenue sourcing book, which contains a retirement planning strategy for today's economy. When you go to requestyourreport.com and let me know where to mail the report and the book, you'll also get a lot of bonus information. We send this out to you free and with no further obligation just go to requestyourreport.com. Let us know where to mail the stuff, and we will be very glad to do that. I will be back after these words with my special guest, Mr. John Williams. Welcome back to RLA Radio. I am your host, Dennis Tubbergen. Joining me on today's program once again is returning guest, economist John Williams. For those of you that are unfamiliar with John's work, I would invite you to go to his website. It is shadowstats.com. The website, again, is shadowstats.com, and I am a big fan of John's work. It's a great way to sort out what's really going on in the economy and inflation. And John, welcome back to the program.
Well, thank you for having me, Dennis.
So, John, for our listeners maybe that aren't familiar with your work and what motivated you to found Shadow Stats, can you share just a bit about the kind of work that you do?
Sure. As an economist, I started off a fairly normal path with some new approaches to econometric modeling. Econometric modeling is how many economists try to forecast ahead. They'll look at the past, the relationship between different numbers, and then try and forecast ahead using their formulas. The problem is that you have some big scale models that'll take you 3 years into the future. The only problem is that the numbers that you're basing those forecasts on don't have a 3-year lead time. I mean, you've got 6 to 9 months lead time with most numbers at best. So I started off developing forecast models with a basically 6 to 9 month lead time. That far out you could predict things such as interest rates and movements in the economy. Where I had some success with that and people liked it, then the government started playing around with its numbers, which made the forecasting a little more difficult. And when I say playing around with their numbers, I'm talking about early 1980s. And let me take you a little bit further back in time. When Nixon closed the gold window in 1971, that effectively severed the direct relationship between the U.S. dollar and gold, its convertibility. And as a result, inflation began to surge. By 1981, we were beginning to see a pickup in the headline inflation. Gold generally measures inflation over time. If you look at gold, price of gold, what you could buy with it in ancient Rome, let's say a loaf of bread, same amount of gold would buy you a loaf of bread today. I was at a monetary conference a couple of years back in New York, and one guy was complaining how his mother so a little girl had been taken to see Broadway plays, and his parents would always get third row center, which is considered the prime seat. And today they'd buy her seat for $5, and today you couldn't come close to it for $5. You'd be looking at a couple of hundred. So what I told him very simply was that if his mother still had the $5 gold piece that they'd bought the seat for before, it'd still buy that seat. Gold preserves a purchasing power over time, and there's some variability. But when Nixon floated the dollar, that people had less confidence in the dollar. Inflation started to pick up and come in and go into the early 80s. The federal government was looking at what the higher inflation was going to do, the cost of living adjustment for people on things such as Social Security. So they decided to recast the way they calculated elements of inflation. And the biggest factor right up front was the cost of housing. And what they did there was they eliminated where people own their own homes, the cost of people owning a home and everything that goes with that, to converting it into what they called a homeowner's equivalent rent, which knocked about, the effect was it knocked about 1.5 percentage points off the headline CPI number on an annual basis. That's for the whole CPI. And so that reduced the level of the headline CPI, and it reduced what had to be paid out in cost of living adjustments. They met their goal there. The problem was that was never the concept of the CPI or its adjustment. The idea of the Consumer Price Index, as it was originally defined, was the cost of maintaining a constant standard of living. And you had, by 2005, you had people like then Fed Chairman Alan Greenspan arguing that, if a steak gets too expensive, people buy chicken. So really we should substitute chicken for steak when that happens. That's not maintaining a constant standard of living. And the substitution effect that was put in there, that's another element. Over time, what I did was I started estimating what the Consumer Price Index was ahead of, as it would have been had they not made their definitional changes to how the CPI was calculated. And over time, that has built up to be a fairly significant number, up around 8 or 9 percentage points. And that, so that I estimate what today's CPI would be based on the all the changes, if they hadn't been made, if they still reported the numbers consistently.
John, can I jump in there just a minute? Because I think a perfect segue for our listeners would be, and by the way, if you're just joining us, I'm chatting with economist John Williams. His website is shadowstats.com. So, John, when you look at these, I think it's fair to use the word maybe manipulated. Maybe that's too strong a word. When you look at this manipulated CPI number, which came in just above 7% most recently, when you go back and calculate the inflation rate the way it was done, in the 70s, what do you think the real inflation rate is presently?
It'd be up around 14.9, 15%.
Significant. So where do you see it going from here?
Well, it is, first of all, that is, in terms of my measure, that's the highest inflation since 1947. In terms of the government's headline number, that's still the highest since June of 1980, and I'm looking for it to continue to spike. Now, in the week in which we're talking, the Federal Reserve is going to have its Federal Open Market Committee meeting. This is for this is January meeting. And they've already indicated that they're intensifying what they call tapering, cutting the pace of monetary stimulus that they put in place after the pandemic hit. And the financial stimulus, the monetary stimulus by the Fed, has been a tremendous factor behind the surge in inflation. And even with what they're looking to cut back, we already have a very strong and increasing inflation base in place. It's going to take a while to come back, and as expectations move for higher inflation, it becomes self-feeding. I think they're going to have a very difficult time containing it. Not only are they talking about reducing the level of what they call that tapering, cutting back on the monetary stimulus. The Fed, at least last time around, blamed the inflation on robust economic growth. And while the headline gross domestic product, which is the broadest, the GDP is the broadest measure of economy, and it has minimally recovered its pre-pandemic peak, the basic economy has not. And if you raise interest rates in something shy of a really booming economy, you're going to drive what's already weak economy deeper into the ground, and that's what they're looking to do. I mean, there's no way they've got a strong enough economy here to blame robust activity on the surging inflation. Let me give you an example as to why. Right now, we're seeing really extreme distortion still from the pandemic disruptions. The numbers are not being normally surveyed and calculated. And I think when all the dust settles and we get better quality statistics down the road, you'll see that there was some exaggeration in things such as the GDP and numbers that are based on surveys by the government. For example, the unemployment rate. The Bureau of Labor Statistics used to go out and knock on doors and talk to people in the street, and they don't do that anymore. They don't have their agents see people directly. They call them on the telephone. They can't reach them on the telephone. They don't get counted. And they acknowledge that their unemployment estimate is shy of reality. Fed Chairman Powell's indicated that as well. But there's another element to the employment reporting. It's on a different basis, and that's called payroll employment. That reflects people who are employed and where payroll taxes are paid by companies to the government on the salaries, the incomes. And those are filings that are made with the states and the government. And those are hard numbers. And from what I can see, it's really the only hard economic statistic out there at the moment, where there's a solid base behind it. It's not tied to the whim of whether or not someone's available on the telephone during the COVID crisis. These are people who are actually working and receiving paychecks. And what you'll see right now is that although our payrolls are well recovered from the bottom is maybe down 10.4% or so from the year before. We're now down something like 2.3%. You say, well, hip, hip, hooray, we're recovered. Not quite. And so it's much better. But what I've done is I've gone back and looked at a change in payrolls against the pre-recession peak and all the recessions back to World War II, and I would say we're down 2.3%. So we're still 2.3% shy of recovering the level of payrolls seen before the pandemic hit. It's against the pre-pandemic peak. And if you go back and you look at the historical recessions, that would be a weaker trough than 5 of the last 8 recessions back to 1957. And the others that were steeper were the Great Recession and such. It's improving, but we're still well shy of a normal economy. In other times, we'd still be deep in a recession. And that's not the time when you start raising interest rates.
Well, John, the clock says we need to leave it there, but the good news is we have one more segment with John Williams. My guest today, Mr. John Williams. His website is shadowstats.com. I'd encourage you to check it out. I'll continue my conversation with John Williams when RLA Radio returns. Stay with us. I'm Dennis Tubbergen. You're listening to RLA Radio. My guest today is economist John Williams, who's got a terrific website, shadowstats.com. John tracks economic data that the way that it used to be tracked. And John, let's just jump right in again. You had mentioned in the first segment that inflation calculated the way it used to be calculated is in the 15% range. You said you probably expect that to accelerate. And it seems to me, John, the Fed's got two choices. They taper and the economy crashes, or they continue to create currency and we have more inflation, maybe even hyperinflation. So how do you see this playing out?
Well, in fairness to the Fed, what they did in back in March of 2020, I guess it was, when the pre-pandemic peak was February and March, they started pumping extraordinary money into the system. And they had to do that. They had little choice because we're facing a potential systemic collapse. This is not just a recession. It was something unlike anything seen in modern times. And so they pumped as much liquidity as they had to in the system to keep things afloat. They kept things basically afloat. The economy still had its steepest sinking of modern times, and it's come back some, but again, it hasn't recovered. Yet they have to keep that cash flowing to keep the system up. It's not fully recovered, and again, where they're talking about possibly raising interest rates, if they do that, that's going to tank the economy. The Fed's primary concern, they mention two things basically: inflation and economic growth. They want to keep inflation low and economic growth and employment high, which are fine goals. But the Fed is owned by the banking system, and the Fed's primary function is to keep the banking system afloat. And where they have to keep the banking system afloat, which will generally go with the economy, they don't have too much choice here. They've got to keep pumping money into the system, and you're going to see still higher money supply growth. You're going to see still higher inflation, and I think accelerating inflation, where we actually get to a hyperinflation. It can come very quickly once it starts, but people will talk about the velocity of money, the speed at which the money supply turns over in the economy. You take the level of the GDP and you take the level of the money supply in nominal dollars and divide the money supply into the economy, and the higher the velocity, the higher the ratio there, the turnover. In theory, the higher will be the inflation rate, and there's an element of truth to that. But that's with a relatively healthy economy, because if you have a rapid turnover there, it means you have a strong economy, and the inflation is being driven by strong economic activity. The dangerous circumstance is the one we have now with relatively low velocity, where the money supply is expanding rapidly and the economy is subpar. It's really not growing much if you look at the better quality numbers, and it hasn't recovered where it was. That's where you get too much money going after too few goods, and that's what tends to spike the inflation and give you hyperinflation, which like you saw in the Weimar Republic or Zimbabwe. And we're seeing extreme stock market volatility this last week or so. It's not a happy circumstance. The Fed is very concerned about stocks because that affects a lot of their clientele and the stock market, and they want to keep the economy strong. Again, they've got to keep the banks functional, which means pumping more cash into the system. It means higher inflation, despite all the Fed say. The rest of it is they're talking back and forth, and I think you're going to see in this week's FOMC meeting a little bit of hedging there, where the last time around they were things are just fine and dandy, and we're going to go ahead and raise interest rates the middle of the year and reduce our monetary stimulus rapidly. It's difficult. It's going to be real difficult to do that, so they're going to be hedging back and forth. That's what I would look for them to do here, but the end result is still going to be higher inflation, and it's very close to getting out of control.
So, John, do you see this ending in a hyperinflation, and what does that look like?
Well, in a hyperinflation, yes, it's not a virtual certainty, but it's a fair shot, and especially with the Fed starts killing the economy by spiking interest rates, you're going to be getting some kind of an inflationary recession, hyperinflationary depression. In that case, the money effectively becomes worthless. You could give you an example from the Weimar Republic. Before I was an economist, I was involved in the chainsaw industry, the family business, and we imported a saw from West Germany, and I got to know the people there very well, and had a chance to talk with people who had actually lived through the Weimar inflation. And this was after World War I. The Germans lost. The French effectively took their gold and they printed money. And as the inflation picked up, people knew they were getting into trouble, because if you wanted to, let's say, go out for dinner, and one night you would negotiate the price of your dinner before you sat down, because after the dinner it would cost you more. And if you'd had an expensive bottle of wine that night, the next morning that empty bottle of glass would be worth more than it was the night before, filled with expensive wine. I mean, that's how rapidly it was deteriorating at the end. But it got to the point that effectively the currency was worthless. And you saw that in Zimbabwe, which is probably the worst hyperinflation anyone's seen. That was actually enabled a little bit by the U.S. dollar. Because in Zimbabwe, the finance minister there said he was following the actions of our Federal Reserve Chairman, I think this is Alan Greenspan at the time, and he was just printing money. And it got so the what was a $2 bill, eventually they kept reprinting, and they increased the denominations on what was equivalent of that $2 bill. It got up to something like $100 trillion. Never seen anything like that before. But what happened was, and there may be some lesson here or something that falls in between, but I think gold and silver are the areas that remain the best store of wealth here that will save the day for many people. Is that at that time the dollar was reasonably, our U.S. dollar was reasonably stable, so that if you were working in Zimbabwe and you got paid in Zimbabwe dollars, you immediately ran down to the black market and exchanged it for U.S. dollars, and you held those dollars as a store of wealth. Here we're looking at a problem with the U.S. dollar. It hasn't hit yet. We are seeing higher inflation, but that's a depreciation of the purchasing power, and most people's incomes are not rising at 14% per year right now. So they're losing purchasing power, and when that's rising at 1,000% per year, the purchasing power is going to evaporate. Again, the currency becomes worthless. So you try and convert the cash into something that has some value. In this case, we don't have the U.S. dollar is the element that's going to be hit. Holding physical gold and silver is a traditional store of wealth, and one I think is probably the best bet right here. It's worked over millennia, and the governments do everything they can to try and squelch the purchasing of gold and silver, because that usually indicates they're not doing their job. But since Nixon went off the gold standard, and I started publishing my alternate CPI measure, if you plot the price of gold against the CPI, you'll see that the price of gold, has been hit up around $2,000. Well, what used to happen was that at the time that Nixon went off the gold standard, the price of gold was around $78, $79. That happened to be the level of the CPI as it's currently published, as they're on an historical basis for that period of time. And my number would be the same, because my numbers don't start changing against the headline number until the early 1980s. And if you look at a plot of gold, which skyrockets, curved upwards, the headline CPI rises, but it flattens out. My number keeps right up with the price of gold. And in fact, what my number is telling you is that if the real inflation is up around what you're seeing with the price of gold in terms of change, that the price of gold is still holding even with inflation, maintaining your purchasing power. And,
John, in the time we have left, it seems that this move from a fiat currency to gold and silver perhaps has begun. I just read an article that I think the Central Bank of Russia now actually has more of their reserve holdings in gold than in U.S. dollars for the first time in history. So, I mean, are we seeing the beginning of this movement out of fiat toward gold and silver in your view?
Well, we have been for some time. I mean, not only the Russians, but the Chinese have both been extraordinary buyers of gold. They have a pretty good sense of where things are going, and it's they view themselves as our competitors, and I'd be encouraging people to align. I mean, at least in the United States, people have the ability to buy physical gold and silver. I look at coins for the reason that if we get into a hyperinflation, and that's the real danger here, which could kill you otherwise. Hyperinflation, your paper currency becomes worthless. But in a hyperinflation, if you have you go to the grocery store. Let's say you've bought a bag of old silver U.S. coins. You can trade a quarter for food. You can trade a quarter for food with a farmer out in the country. It's not things are not going to be easy in terms of regular commerce. Back in Germany, the stores, the shelves just went empty overnight with the panic there. But with the precious metals, you have something that you can actually barter with that are meaningful. The gold for bigger areas as well. But I tend to buy coins because people recognize the coins as being legitimate, or at least they'll say, well, yeah, okay, that's probably real gold or real silver, as opposed to a bar that they might want to assay. It's just in a barter situation. I think the coins are the better bet.
Well, my guest on today's program has been Mr. John Williams. His website is shadowstats.com. I would encourage you to check it out. John, always a pleasure to catch up with you. Appreciate your updated forecast, and would love to have you back again down the road. Thank you for joining us today.
Well, you're most welcome, Dennis, and always enjoy talking with you. Good luck.
We will be back after these words. I'm Dennis Tubbergen. This is the Retirement Lifestyle Advocates radio program. And thanks again to my special guest this week, Mr. John Williams, for joining us on today's program. We've been talking about Fed policy on today's program. By Fed policy, I mean Federal Reserve Bank policy. If you're a new listener, the Federal Reserve is a private bank. And back in 1913, Congress and then President Woodrow Wilson thought it would be a good idea to give control of U.S. monetary policy to private bankers. Now, past guest here on the program, Mr. Peter Schiff, wrote a piece on this that was published about a week and a half ago. The title of his article is "The Federal Reserve is a Money-Making Enterprise." Now, probably shouldn't come as any surprise that the Fed makes money, because the Fed can create money out of thin air and then buy yielding assets. Now, what does that mean? Well, they can create currency out of thin air and use that newly created currency to go buy bonds. And those bonds pay the Fed interest. Now, the central bank, the Federal Reserve, recently released its unaudited preliminary financial statement for 2021. The Fed's total net income for 2021 came in at $107.8 billion. $107.8 billion. So Schiff, in his piece, asks, how does that level of income, that level of net income, compare to a legitimate business? Well, he used the example of Apple, and Apple booked a pre-tax income of $109 billion in fiscal year 2021. So that puts the Fed, as far as net income is concerned, on par with Apple. Now, the Fed's total revenues for the year came in at $123.1 billion. They had expenses that dropped the net income down to $107.8 billion. Well, they received $122.4 billion in interest on holdings, basically bonds, treasury bonds, and mortgage-backed securities. And again, to make the point, the Fed creates currency, It uses this newly created currency to go buy bonds, and then it collects the interest. Pretty good deal, huh? And by the way, the Fed does not pay taxes, but it does remit nearly all of its net income to the U.S. Treasury as required by law. Now, Schiff points out that plenty of people still get a cut of the pie before the Fed sends all that cash over to the federal government. The Fed paid $583 million in statutory dividends to the shareholders of the 12 regional Federal Reserve banks. Bankers also get a nice cut. The Fed paid $5.3 billion in interest on the reserves it holds for banks. That's at a rate of 0.15%. Now, the Fed also has expenses. For example, it costs them $1 billion to produce, issue, and retire the paper dollars that are getting worn out, and about $2 billion expenses for foreign currency revaluation losses. Uncle Sam's cut was $107.4 billion, which was the highest level since 2015. And Schiff said, the lesson here is there's big money in central banking, and it's nice work if you can get it, but you can't. Meanwhile, world central banks, the same banks that are issuing fiat currencies, are stockpiling gold. According to data recently released by the World Gold Council, as of September of 2021, the total amount of gold held in reserves by central banks globally exceeded 36,000 tons for the first time since 1990. This 31-year record was the result of the world's central banks adding more than 4,500 tons of gold to their holdings over the past decade. Now, if central banks that are issuing fiat currencies are buying gold, what does that suggest that you might consider? Now, the U.S. currency, the dollar, still dominates all others in international trade and in reserves. However, this is quickly changing. Bloomberg issued a report just a few weeks ago that reported that the Central Bank of Russia now holds more in gold than they do in U.S. dollars. The Central Bank of Russia has gold reserves amounting to 23% of its total reserves and dollar reserves amounting to 22% of its total reserves. Now, it's important that we look at what central banks are doing rather than listen to what central banks are saying. See, these central bankers clearly understand that as fiat currency debasement continues and even accelerates, physical gold for part of your assets is a good thing for many investors to consider to provide a haven from this debasement. Now, to that end, I have some resources that I've been offering on today's program and all this month during the month of January. I do have a report titled The Changing Face of Long-Term Medical Care that I'll be glad to send you if you go to requestyourreport.com. And when you go to that website, requestyourreport.com, I'll also send you a copy of my best-selling revenue sourcing book, which contains a retirement planning strategy for the post-pandemic economy, as well as a lot of bonus information, all very timely to the topics we've talked about today. Again, go to requestyourreport.com, give me your name and address, let me know where to send your box of stuff, and I'll be glad to do so at no cost or obligation to you. That's requestyourreport.com. That's all the time I have for this week. Hope you got something you can use, and I'll be back again next week.